As we have been reporting, as our Dominic Chu reported earlier, FedEx, the world's biggest air cargo carrier, has forecast an annual profit trailing analyst estimates. The stock is down about 2% right now on the news, but our next guest says the reported numbers are not disappointing at all, quoting here, not in the slightest. Daniel Ortwerth is an analyst at Edward Jones, and based on data compiled by Bloomberg, he's one of the most accurate FedEx analysts. Daniel, welcome to Bloomberg News. Always good to have you on.
Good to be with you.
Talk to me about these numbers. You say they're not disappointing. Why not?
Oh, no, Mark and Julie, I'm happy with these numbers because the heart and soul of the future of FedEx's story is a global business, not a U.S. business. And I saw 23% growth in their international volumes, and that number is accelerating. I saw them put out plans to buy more jets and put down $3.2 billion in investing in the future of that business, and they did not have to sacrifice the quality of the balance sheet to do it. They're still paying down debt. So we see a healthy company that's focused in the right direction, and we think that this reaction to the supposedly weak guidance today is just a buying opportunity for the long-term investor.
Dan, you say that there are three things that we should be looking at here with FedEx. What are they?
Well, once again, the focus on the global business. How is that global business performing? And that 23% growth in the international volumes that we saw is testament to how healthily it's performing. The second thing is whether they're staying the course in the midst of these difficulties. $3.2 billion and more 757s and 777s to continue that global expansion. And once again, taking care of the balance sheet. Are they staying healthy? In this last fiscal year, they paid down more than $500 million of debt. So we think that they're doing what they have to do to keep themselves healthy and to think globally about the entire business.
Dan, talk to us about FedEx's strength, particularly how it was able to come out of this global economic downturn and still, as you said, have momentum going forward to expand globally.
They took 10 years from 1999 to 2009 to continually work on making the business more flexible and more profitable. And so when the difficult times came, they had a cushion and they had an ability to reduce expenses more than everybody thought. Sure, the recession hurt them, and in fact, it hurt them badly. It perhaps cost about 3 years' worth in terms of the overall growth of the business. But they came through the business with the business model intact, with the customer relationships intact, and with the business continuing to expand globally even during the tough times.
Talk to me about FedEx and at the very least this situation concerning the freight business and how healthy that is going to be going forward.
Yeah, that was some pretty tough timing there, Mark, because they expanded into what has proven to be the most cyclical part of their business at the very time that the economy was tipping over and coming down the bad part of the cycle. So that hurt them. It definitely did. And that's unfortunate timing. Nevertheless, in our view, we're talking about an expansion that made good sense. It gave them the ability to take their core expertise of time-definite, reliable service to another set of customers who can use that service. So yeah, it's hurting them here in the near term, but I think that once we get through this initial stage of the recovery, we're going to see that it really did make sense.
Where does FedEx fit in the overall U.S. economy?
Well, it certainly is a big part of the U.S. economy because of just how much they ship, especially for industrial customers. You know, industrial production is probably still the biggest indicator of how their business here in the U.S. is going to do. But that's really kind of fading because they're taking the business global and they're not focusing on the U.S. economy like they used to. So I think that we need to shift our mindset from saying that they are a bellwether of the U.S. economy to saying they're a bellwether of the global economy.
Talk to me then about the core U.S. domestic express business. Is that still disappointing?
Well, it is disappointing, or at least it's disappointing to the outside investor. But for about 5 years now, FedEx has been saying that business is mature. It's just not going to grow so much anymore. And they've been doing everything that they can to communicate that message to the investor. But I think the investor still wants to think of that as a growth business, and it's not. In fact, they haven't invested in that part of the business for its own sake in a long time. They keep investing in it to support the global franchise, but not for its own. So I think that U.S. domestic business is going to continue to grow below the growth rate of the U.S. economy for the foreseeable future.
Dan, in about our last 30 seconds, talk to me about FedEx and the competition, specifically UPS. You have a hold on them, right?
Right. UPS and FedEx are both excellent companies who are doing the right things. But in our view, UPS has always geared itself for stable performance, and FedEx has geared itself for growth. So as we're coming into an economic recovery, especially in our opinion, led by global strength, in our view, UPS is still a good, solid holding, but FedEx is going to give you better growth in our view.
Dan Ortwerth of Edward Jones talking FedEx on this Wednesday afternoon. Dan, thank you so much. A pleasure to have you on.
Time.